Hello and welcome to Recourse versus Non-Recourse Loans. I'm David Ackert. I'll be moderating the presentation for you. With me today are Karin Hall. Hi, Karin. Thanks for joining us.
Well, thank you so much.
Karin is with UDirect. And also Brent Houston from NextGen Real Estate. Hi, Brent.
Thank you, David. Hello to you, too.
And I see that we have quite a few attendees on the webinar, so we're going to go ahead and dive in. I will also be taking questions throughout this presentation, so if you do have questions, feel free to ask them, and I'll make sure that they get directed to our speakers. Just a quick housekeeping item before we move forward. If you're having any trouble hearing us by way of audio, if there's an echo in the audio, or if for some reason you get disconnected, both of those things are easily resolved. We find that when people dial in rather than use their computer speakers, they can resolve echo issues, so that may be something you want to try. You'll find the dial-in and the access code in your GoToWebinar dashboard, which will be right there on your screen. And if you do get disconnected for any reason, just log in by going to the website gotowebinar.com and entering the webinar ID, which you'll also find on the dashboard. But just in case you want to make a note of it, it's 119-937-587. So as long as you click on the Join a Webinar button on their website and enter those numbers, you'll be placed right back into this program. All right, so without further ado, let's talk a little bit about NextGen and the solutions that your firm offers. Brent, can you give us some sense of that?
Thanks, David. Thank you very much, and thank you, everyone, for attending this seminar on recourse and non-recourse loans. Basically, NextGen Real Estate, we are a non-traditional real estate-focused company, where from our website you can see that we provide a plethora of services, private money financing, conventional mortgage brokerage, traditional realty services, as well as a focus on the real estate side of short sales. But our two main distinct business models, and really our focus is that we're really committed to providing solutions for property owners as well as investors within this distressed marketplace. The two distinct business models are going to be the financing side of things, as well as the realty brokerage. And the focus is really just trying to have a completely transparent, open dialogue with all parties within the transaction, whether it's the buyer, the seller, the investor, the lender, escrow, title, short pay lenders, and just trying to really come with a win-win situation throughout the entire process. David, next slide, please. Next slide. So within our two main areas, our realty services, we are really going after the short sale marketplace. We have currently approximately 75 active short sale listings throughout the entire state of California. We're getting anywhere from 1 to 3 new listings a week, and we've actually just nailed down a very interesting business partner where we'll probably be getting anywhere from 15 to 30 new leads, new listings a week. So again, that's very focused within the short sales, and especially individuals that have self-directed IRAs that are looking to be picking up real estate within the portfolio. Do contact us on a regular basis looking for excess of inventory, and that's something in which we can help out with. Our next distinctive business model is going to be our private money financing, in which basically NextGen, we're providing financing for those borrowers and or properties that don't really fall into conventional guidelines. So we're doing a lot of non-recourse financing. A lot of investors are having a very difficult time on trying to obtain that type of financing through conventional means. And so we're really aggressively going out there trying to provide a niche for those investors, and especially cater to those buyers within our short sale products. Investment management just kind of goes hand in hand with doing private money financing. We need to make sure that we're servicing that debt correctly for our investors and also for the borrowers. Our investors have 24-hour access to their pipeline, to the workflow, to debits and credits within their account. You can log in and see exactly what products are making up your portfolio, the types of interest return that you're obtaining within your portfolio, what's performing, what's not performing. So,
very good. Well,
so basically, what we want to do. Go ahead, David.
No, that's right. I just wanted to prime this question. You're on a roll, so I'll hand the baton right back over to you. But this leads into self-directed retirement accounts, and I wonder if you can help us connect the dots between the services that NextGen offers and why a self-directed retirement account is important.
Well, going into self-directed, and really that ties into this whole discussion of recourse and non-recourse loans, and understanding the importance of using non-recourse loans within your self-directed IRA. There are a lot of investors out there right now looking to purchase REOs or short sales that are cash flow positive from a rental income perspective. Right? Investors are very frustrated having the financing or their excess of capital within the bank obtaining less than a 1%, even a 0.5% interest on that capital. And by integrating that within real estate and using a self-directed IRA to purchase investment properties or deeds of trust or what have you, you can generate in excess of 8, 10, 15% return, cash on cash. So, and if you leverage that cash up by using non-recourse loans, those IRRs can get north of 15 to 25%. So it's really important to understand what services are out there, and it's important to align yourself with a very well-educated self-directed IRA company because there are things which you might not know you could otherwise do within your account. So,
very good. Well, thanks for the explanation. And we want to give the participants an opportunity to take this poll. So the question, as you can see, is do you currently have a self-directed retirement account? This is an interactive poll that we're going to be launching here. So please answer the question yes or no, and then we'll share the results that we gather from your response. So go ahead and click one or the other now. And we see So
I see there's only two answers, either yes or no. So we should be able to get 100% participation on that, right?
We've got about 64% of the participants have voted. 71, we're almost there. Okay, and we're at 71%. So most of the people on the program have voted, and we see that we have 60% with a yes and 40% no for a self-directed retirement account.
Well, good. I think this presentation will go very well for those 40% that don't have self-directed IRAs, and I know Karen does a wonderful job within her side of the business, and that's why we wanted to have her come in and speak about UDirect and the types of services that they offer. So,
very good. Well, let's do that now. We'll give Karen the baton. So, Karen, I've moved the presenting over to you. Do you want to tell us a little bit about UDirect? Karen, are you there?
I hear you, David. Do you have her as being logged on?
Yeah, Karen, I wonder, are you muted by chance?
Well, we see her presentation coming up.
There we go.
Okay.
There we go. I apologize. It had to do with a slow computer, so I appreciate that, guys. Thanks so much. I love technical difficulties. Well, self-directed IRAs, it's something that I've been involved in for a long time now, and there's just so much to know. And non-recourse lending is a critical key to leveraging your IRA, and just understanding it is so helpful. So I'll just go on with my presentation to say that UDirect IRA Services, what we do is provide the account. What we don't do is give you tax or legal information or advice. And we don't give you investment advice. We're not going to say what is a good or a bad investment. So with that said, we can go forward. Of course, self-directed IRAs are for retirement purposes only. And so when you take that into consideration, when you're thinking about retirement, one thing to consider is that there's something like a $6.6 trillion deficit out there between what Americans have right now and what's needed for retirement. It's a crazy deficit, and so you don't want to be caught in that gap. So my point is just to save for retirement no matter what you do, because if you had $100,000 in retirement savings right now, say you were 59 and a half, and no gain or loss, and you knew you were going to live until you were 86 and a half, and you took equal monthly payments, that's less than $400 a month. So you really have to build up that retirement account so that you have enough to live on when you do, in fact, retire. Now, with total retirement funds, when we look at the whole pie throughout the nation, it says here 17 trillion, but that number has really been updated. I was at a conference in October, and it's more like 18.5 trillion in retirement money. Only 3% of it is self-directed, so there's a huge pool of retirement money out there, and only 3% is in alternative assets. Interesting. If you've not heard about self-directing, and I know 40% of the audience does not have a self-directed retirement account yet, so if you never heard about it, understand that basically, it's not unusual that you haven't heard about it. In fact, what's surprising to me is how many CPAs and how many attorneys are not knowledgeable about this. But self-directed IRAs have been around since 1974, since President Ford it was who signed it into law at that time. So it's been a long, long time. I mean, longer than even some of our listeners have been alive that you've been able to self-direct. It's nothing new. And the only difference between a typical IRA and a self-directed IRA is the asset that the plan can buy. So instead of just buying stocks, bonds, and mutual funds, now your IRA can make a loan to somebody else. Now your IRA can buy a house. Very exciting stuff. I mean, a lot of people don't know that they have this kind of freedom, and when they find out for the first time, it's pretty exciting. Of course, like with any retirement account, and in a self-directed IRA is pretty much like any retirement account when it comes to contributions and distributions, but losses, they are the same as well. They can't be written off easily, and they're not easily replaced. So you just want to make sure before you invest, do your due diligence. Take a few minutes, Google the names of the principals, because losses are, are tough to replace, and it's precious money. You can't just, stick a big chunk of money in there. You're limited by contribution limits. Now, the limits on what you can invest in with a self-directed IRA, that's pretty exciting because the IRS doesn't tell us what we can do. They just tell us what we can't do, and it's this very short list that you see right here. You're not going to invest in life insurance contracts. You're not going to invest your IRA in collectibles. So your IRA is not going to buy like a fine wine collection, for example. So life insurance and collectibles disallowed. But what if you are working right now for an employer? That employer offers you a plan, like say, for example, a 401k, and you think, wow, this is great. I'm going to take this money and I'm going to self-direct it. I'm not going to invest in, say, real estate. Wonderful. However, it's great to save for retirement, but you may not be able to use that money to self-direct because you pretty much have to wait until you leave the company. But you can ask for what's called an in-service transfer. You work there, you're in service, but you want to transfer the money. More times than not, they say no. But if you're 59 and a half, for example, then they're likely, much more likely to say yes, you can have that in-service transfer. Okay, so let's talk about self-directed IRA rules. And I think it's crucial to talk about this because you want to have the right expectations when you go in. I mean, if you expect to be able to invest with IRA money the same way that you can invest with your own personal money out of your checkbook, you're going to be disappointed, and your plans that you're making may or may not work. So some of the guidelines are written on the website. IRS.gov, publication 590, covers some of the guidelines. Really, they're written into the Internal Revenue Code, the IRC 4975, but we're just going to break it down quickly for you. So you're not going to borrow money from your IRA. You're not going to sell any property that you personally own to your own IRA. You don't use it as security for a loan, and you're not going to use your IRA to buy property for personal use, whether present or future. So that's good to know. But also, to take it a step further, certain people are allowed and certain people are disallowed to your IRA. Very important to know. So disqualified people are your lineal ascendants and descendants, your parents and grandparents and their spouses, you and your spouse, and then your children and your grandchildren and their spouses, all disallowed to your IRA, plus any fiduciary to the plan. But the people who are allowed are the people out to the sides, like your aunts and uncles, your cousins, brothers and sisters. They're qualified or allowed. So let me explain to you how that's applied. It breaks down into prohibited transactions, and they fall pretty much into these three categories. This is really the crux of our presentation today. Number one is that neither you nor a disqualified person can benefit from the IRA. And that means present benefit, it means personal benefit, indirect benefit. The only benefit you're supposed to receive from an individual retirement account is retirement benefit. That's it. So you want to make sure you're not benefiting today from what you're doing. That's one litmus test or one question to ask yourself before you go to invest. Number two, you can't buy, sell, or exchange property between the plan and someone who's disallowed. Remember those lineal ascendants and descendants of fiduciaries. Your IRA is not going to buy a piece of property that your father owns. Your IRA is not going to sell an asset to your children. That's how that works. Number three is interesting because it really does trip a lot of people up, and that is that a disqualified person can't provide goods, services, or facilities to the plan. All right. So basically what that means is that if someone is, say, for example, a real estate agent, and their mother's IRA wants to go ahead and purchase a property, and the person says, well, hey, I'm a real estate agent, it's my mom, who could help her better than I can? But understand that if it's your mother's IRA, you can't provide services to the plan, whether you're paid or not. So just keep everything arm's length. That's a good rule to remember, and then you should do just fine. When it comes to the structure of a self-directed IRA, here again is an expectation you might not have. You might just think that, hey, guess what? I'm going to take my IRA and just buy something, so maybe I'll go buy a property. I'm going to put it in my name and sign the purchase contract. But that's not how it goes with the self-directed IRA. There's you on the one hand, and then there's your IRA on the other hand. So when you go to make an offer, the offer is made in the name of custodian for the benefit of your IRA. So there's you and your IRA. There's us, the point of contact for everything, opening your account, taking you through the whole process. That's UDirect IRA Services. We hold your hand from beginning to end on everything. Then we have enlisted a custodian. When I formed UDirect, I interviewed a lot of different banks and trust companies and chose American Estate and Trust to hold our clients' money. So they are the custodian. We're the TPA, or third-party administrator. When you buy real estate with your IRA, pros and cons, I think the biggest side is that it's capital gains are tax-free or tax-deferred, any kind of money that rolls back into the IRA. No time limit for holding the property. So it's not like a 1031 exchange where you've got the clock ticking at all. And as we're talking about today, your IRA can borrow money, and that's what Brent is going to elaborate on today and what he has been talking about. Of course, there's also a potential to earn a larger rate of return on invested capital, and the reason for that is because when the money comes back in from an investment, it's not diminished by tax. 100% of the money that comes back in the IRA can go back out into the next deal. Now, the downside about buying real estate with your IRA probably is an expectation that is not going to be met, and that is that you're not going to get to take the write-offs on your IRA-owned real estate that you can take on your personally owned real estate. So don't expect to have any of those write-offs. You're solely responsible for the gains and losses. You can't replace them very easily. Again, do your due diligence. Nothing replaces due diligence for sure. Now, your IRA can take a loan. Brent is going to elaborate on that, so I'm going to skip right past it. I am going to mention that when an IRA borrows money, it can possibly lead to a tax called UDFI, Unrelated Debt Financed Income Tax. And there's another time when an IRA can be taxed. That's called UBIT, Unrelated Business Income Tax. So do your homework, learn about these taxes ahead of time, go to IRS.com, look up Publication 598 and research it. These taxes are reported to the IRS on a Form 990T that your tax person will fill out for you. And just, learn more about it. Talk to your tax advisor and find out if you're going to be subject to these taxes. Now, how do you get real estate into an IRA? All right, that's a good question because a lot of people know, of course, how to put a stock in an IRA. You pick up the phone and you call and say, hey, I'd like 100 shares of Apple, and you look at your account a day or two later and boom, there it is. With an IRA, it's a little different because, of course, first you're buying real estate, which is much different. But the very first thing is to, again, make sure you've got that account open first because this is the timeline. You open an account. We get it open for you usually the same day. But then what you need to do is get money in your self-directed IRA. That's going to take a couple weeks because we are going to be depending upon a third party, the company currently holding your money, maybe your old 401k provider, maybe your old IRA provider. They have to move the money over. They're not going to be in a big hurry to do that. So it's going to take a couple weeks. So just know that there's this timeline. You want to get the account open, you want to have money in it, and then your IRA can make an offer on property and, give us an earnest money deposit and that sort of thing. So it's the IRA that's the buyer, not you. You don't sign the offer to purchase. We sign it on behalf of the IRA. The way you do that is you give us a direction letter, you give us the supporting documentation, we review it, and then 24, 48 hours later, the money is dispersed out into the deal. So it funds, it records, you get your keys, your tenants move in, and then the tenants are going to make their rent checks payable to the IRA, to, custodian for the benefit of the IRA. They could also make their check payable to a property management company and have the property management company send the proceeds in, which is really a good idea because you need to keep things arm's length. If there was ever like a repair needed or something and you had a property manager, that would be great because remember, you can't, you're not allowed to go out there and swing the hammers. It's called an over-contribution of sweat equity. So you're not going to fix things when they break. You have to keep it, arm's length and everything. So having a property manager can solve a lot of problems with the self-directed IRA. Now we're going to skip this example for the sake of time, but just we'll talk about what are we going to do if our IRA, in fact, does deplete its reserves, because when an IRA invests in real estate, it's one of those assets, that has expenses. They don't all. I mean, you buy gold bullion in your IRA. Well, there are not a lot of expenses. It's not going to break, for example. But a house does, and the house is like a living thing. It constantly needs upkeep. You've got to pay property tax. You're going to have closing costs because all expenses of the IRA are paid for by the IRA. So if you deplete your reserves, 6 things you can do. Number 1, you can make your annual contribution. Just write a check. Now, how much of a check? You're going to want to talk to your tax advisor. Number 2, you can liquidate other assets within the self-directed IRA. So maybe you have this house and you have some gold bullion over here. So you liquidate the gold bullion and use that cash to make up the shortfall. Number 3 is you could transfer money from another retirement account. Maybe you still have some stocks, bonds, and mutual funds across the street. So liquidate some of them, transfer them over, and make up the shortfall. You could bring on a partner, as long as they're not a disqualified person, or get a loan. Now, Brent, I'm pretty sure you're not making a non-recourse loan to somebody who's coming up short on their IRA. It's not really that kind of a situation, but it would be a non-recourse loan, but it would need to be probably from an individual because it's not going to be the kind of thing that's going to be well viewed by an underwriter, I don't think. And if any of this doesn't work, you could always just sell the asset. Now, here's another thing you may have heard of. It's often called the checkbook IRA. Wow, what a misleading phrase. It's not a special kind of IRA at all. What it really is an LLC. It's an IRA-owned LLC, and it's a special purpose LLC with special language. There was a court case called Swanson v. Commissioner in 1996, and it formed this whole industry of checkbook IRAs. So here's how it works. You've got a self-directed IRA that's open and has money in it, okay? And then you've got an attorney who draws up a special purpose LLC. Your IRA buys 100% of the initial units of that special purpose LLC. The money flows from the IRA into the checking account of the new LLC. You are the managing member, and now you have checkbook control over your IRA funds. Now, of course, with great power comes great responsibility, and I've really glossed over this entire concept very quickly. I took a 16-hour class on this, and there was still more to say. So if you'd like to find out more, I have a class I did with an attorney that I have a link to. I'd be happy to share it. Just email me at khall@udirectira.com. So khall@udirectira.com, and I'll send you the list, or I'll send you, I should say, the class, the checkbook IRA class, with a short list of attorneys who provide this service. So,
and just so you know, at the end of the presentation, we'll have all contact information as well on the screen, so everyone can write down contact phone numbers, email addresses, and so on and so forth as well.
Excellent. When it comes to self-directing an IRA, I get this question a lot. Well, Karen, they'll say, I'm looking at your website, and I see that you've got all these accounts, but where's the self-directed IRA? So I think the important thing to remember is that IRAs are IRAs, whether they're self-directed or not, just is talking about what kind of assets that plan can buy. So all these accounts can be self-directed. The traditional, the Roth, the inherited IRA, which isn't even on the list, the SEP, the simple, can all be, self-directed. Plus, also a cover dell. It's not even an IRA. It's an education savings account for children. That can be self-directed. An HSA, again, not a retirement account, a health savings account that goes hand in hand with a special kind of health insurance, kind of account. That can be self-directed. All these plans can be self-directed. So just know that you're not limited. There are a lot of different kinds of accounts that can be self-directed. So how do you do this? I say it's as easy as 1, 2, 3. You open, fund, and invest. Open an account. We have a $50 setup fee. Complete the documentation. Our annual fee is $275. That's a flat fee, regardless of the number of assets and regardless of their value. So you give us that information, a copy of your ID and so forth, and then we get your account opened. Now we want to put money in the account. 3 ways to do that. Number 1, write a check. Ask your tax advisor how much. Number 2, an IRA to IRA transfer. To do that, you fill out our form, you sign it, you give it to us, we sign it, we send it to your current IRA provider, they move your money. That's pretty easy, and that's how it works. It takes a couple weeks. The third way to put money in a self-directed IRA is a rollover. This is where you go to your previous employer's plan administrator, and you fill out their paperwork, not ours. And then, again, they're going to take a couple weeks to roll the money over. But once it's there, we send you an email so you know the money arrived. And once it's there, you simply tell us what to invest in. You direct your retirement funds right there, and that is how it works. So I've gone over a lot of information quickly. If you would like me to go deep on any of these topics, I'd be happy to do that. Just send me an email. Again, my email address is khall@udirectira.com. And with that, I will turn things over to Brent and to David. And thank you so much for letting me be a guest on your webinar today. I really appreciate it.
Well, thank you, Karen. That was really helpful. We do have a question from one of the participants. They asked, are transfers taxable? Can you speak to that?
Oh, I love that question. Transfers are not a taxable event. Moving money from one IRA account to another IRA account, whether it's a rollover or a transfer, is not a taxable event. Got it.
Okay, great. So if there are any other questions, we really do encourage you to ask them. The objective here is for this to be as interactive and as informative for you as possible. So we have another poll here. Do you currently have a self-directed retirement account? Now that you have a better sense of what that is and that Karen has helped clarify that, we'll launch the poll. Please do make sure that you answer. Your options are never, I'm in the process.
Actually,
within the past
David, I think that that poll was the first poll that we had going into Karen's presentation.
Oh, that one was, do you currently have a self-directed, oh, I see, you're right. So I guess this slide is erroneous. All right, so we'll move past it. There's another poll coming up. So for those of you who are itching to click a button just now, don't worry, we'll give you an opportunity. All right, so let's see. Let's move into recourse versus non-recourse loans. Brent, I think this is where you pick up the ball and help connect the dots between what Karen spoke about and some of the things that you do. So I'll let you do that.
Right. Well, it's really important for investors and truly understanding and grasping the difference between a recourse and a non-recourse loan, and especially if you're using self-directed IRA, it's really important to understand recourse loans versus non-recourse loans. With recourse loans, the main issue is that liability is going to follow you until the debt is fully paid. So recourse loans, what it does is it allows the lender to come after you, even if the collateral has been taken. Even if the lender has foreclosed on the property and they have taken the property back with a recourse loan, they can come after you for the remaining balance, otherwise known as a deficiency judgment. They can bring legal cases against you. They can garnish your wages. They can levy your bank accounts. They can just make your life utterly miserable within a recourse loan. The other aspect of a recourse loan is, and something that Karen had briefly touched on, was that by having a recourse loan, and if you do go through foreclosure, and if you are are using your self-directed IRA within that real estate transaction, you could actually have that transaction disqualify your self-directed IRA, since a foreclosure could create a prohibited transaction because you could be taking on personal liability and personal obligation for within your self-directed IRA, which would then cause a major issue on that, which could then lead to serious taxable consequences as well. Within non-recourse, the exposed liability is really on the asset itself. Within the non-recourse, it doesn't allow the lender to pursue anything other than the collateral at hand. So if the lender forecloses on the property and they take that property back, they can't come after you for the balance. There's no deficiency judgment. But the issue is that non-recourse loans it pushes the risk to the investor. The investor really is making their decision on that collateral at hand, and so because they have a higher risk associated with that asset, they're typically going to charge a higher interest rate on that side of things. So within non-recourse, you also have very each state has their own specific underwriting guidelines and laws. Here within California, we are known as a non-recourse state for those properties that are being purchased as an owner-occupied primary residence. Where if you're using purchase money and you're obtaining financing for that purchase money, that loan, as long as it's your primary resident, 1 to 4 units, would be a non-recourse loan. The lender cannot come after you for any deficiency judgment. However, if you refinance, take out a second mortgage, or you do a cash-out transaction, that transaction can turn that original non-recourse loan into a recourse loan, and that's something to be very wary of when you are doing refinances and cash-outs on your primary residence. So again, it's important to distinguish between the two of the recourse and non-recourse loans.
Right, I have a question coming in here that I want to run by you. Are conforming mortgages recourse or non-recourse? Can you speak to that?
Are conforming mortgages recourse or non-recourse?
That's right.
Well, the question actually has to go one step further, and doing that conforming mortgage, is it a conforming mortgage for your owner-occupied property, and is that loan for purchase money to acquire the asset or the property, or are you refinancing that property, right? Because I mean that could dictate whether it's going to be recourse or non-recourse. So going back over it, if you're using financing to acquire a property that is going to be used as your owner-occupied primary residence, and it's a single-family residence, condo, townhome, 1 to 4 units in which you're going to reside in there as your residence, that loan would be non-recourse. If you're buying a property as an investment property or a secondary home, or if you're simply doing a refinance, whether it's rate and term refinance or cash out, more than likely that is going to be a recourse loan. Okay, so purchase money, owner occupied is going to be a non-recourse, whereas refinance, cash out, rate and term refinance, or purchase for a secondary home or investment property is more than likely going to be a recourse loan, in which the lender could come after you for the full debt that's owed to them in the event of a foreclosure.
Okay, great.
So hopefully that helps that question.
Thanks for that. If there are any follow-up questions to that, feel free to use the GoToWebinar dashboard for that. So we're going to move on to our next poll. Have you ever obtained non-recourse financing before? So I will launch that now, and please do respond. So
the importance of that is that a lot of times people and individuals are just signing loan documents and not truly understanding the intricate details of the loan in which they're obtaining at hand, and whether there's recourse or non-recourse. And again, I mean, if you're buying a property for an owner-occupied property, the laws are very consumer pro-consumer based, right? They're written to protect you. If you're obtaining financing or a loan for investment purposes, and if you're acquiring a property within your self-directed IRA, that is going to be for investment purposes, because you can't have personal gain on that right now, or else it would create a prohibited transaction. That it's really important to understand the type of financing that you're getting. And a lot of times people are getting a loan and they think it's non-recourse, but in actuality it's actually recourse. So you really need to read the fine print and know what you're doing. So I'd be curious to see how many come up as I'm not sure.
Okay. Well, we have just about everybody voted now. So we have 73% have never obtained non-recourse financing before. 18% have, but it was over a year ago, and 9% are not sure.
Okay. Interesting. All right. So going into the taxable considerations for recourse and non-recourse, and again, looking at taxes and within your self-directed IRA is what can cause that self-directed IRA to become a prohibited transaction, which could null and void out that self-directed IRA. So you have to be very, very careful about that. For recourse loans, again, the lender can come after you for the full amount until they are paid, and they can garnish your wages and just completely make their life miserable. But your tax liability will depend on whether or not you have a recourse loan. So foreclosures are treated as a sale of the property for federal tax purposes, which can cause a taxable event on the forgiveness of the cancellation of debt. Now, in 2007, for primary residents, owner-occupied properties, they had the 2007 Mortgage Debt Forgiveness Act, which is actually set to expire at the end of this month. And basically what that was saying was that if you have a recourse loan on an owner-occupied property, primary resident 1 to 4, and if you were selling that property and you're having debt that was being discharged, that you would not have a federal or state taxable consequence up to $1 million from the federal level and up to $800,000 from the state level in California, as long as that property was a 1 to 4 unit, single-family residence, owner-occupied. But that is actually set to expire at the end of this year. We're not sure as to what's going to happen with the 2007 Mortgage Debt Forgiveness Act, if it's going to be rolled up and extended again with this whole financial fiscal cliff that they're trying to get ironed out, by early January.
Brent, I have a quick question coming in here. What is the tax liability on a deed in lieu?
It's going to be the same thing, but you definitely want to speak with your tax advisor on that. But a deed in lieu looks the same on your credit as a foreclosure. So it all depends on what's written within the small print as to at what price are they buying that property back, and how much debt they're actually going to be discharging, right? So when the lender does a deed in lieu, they're going to take a snapshot of the valuation on that property, and they're going to determine how much debt in which they're going to be writing off. They're going to issue a 1099-C to the prior owner of that debt or of that property that is doing the deed in lieu, and that 1099-C could then trigger a debt forgiveness taxable liability for you. So if you're doing a deed in lieu, I highly recommend you get that done by the end of the year, because you're not sure what type of exposure you're going to have going into 2013.
Very good. Okay, thank you. Let's wrap up this piece on recourse loans, and then we'll move into non-recourse. Any other comments here?
Yeah, again, with recourse, the lender can come after you for the total debt, right? So the figures aren't going to be necessarily black and white. That they're going to be using the selling price of the lower of the two amounts, what the outstanding loan balance is immediately before foreclosure, minus any debt for which the borrower remains personally liable for after foreclosure, or the fair market value of the property being foreclosed. So, lenders, there are two things that can happen. There are three things that can happen in a foreclosure. Either that foreclosure can get postponed. So the foreclosure date is extended out to another future date. That property can get sold to a third party, so a new buyer at the trustee courthouse steps could purchase the property, and a price is established at that time as to what the liquidating price was for the property. Or the property can revert back to the bank. And if the bank takes the property back, well, you're not quite sure exactly what that transaction cost is going to be, because you're not quite sure how much money the bank's going to be selling that property for. So the bank can take the property back. They could have to maybe bring the property back up to code, up to regulation. So they might have to put additional capital into the property to get it ready to be sold via traditional real estate channels. And the more money that the bank puts into it, the lower the net the bank is going to receive, which will then get passed over to you as a taxable liability on that recourse, which the lender would come after you for the deficiency balance. And that goes into the non-recourse loans. And with non-recourse, the collateral is at hand. So whatever happens with that collateral will determine what that taxable event is going to be. Figures that are used are the selling price of the outstanding loan balance immediately before the foreclosure. So if you know what is owed on the property, you understand what the debt is on that property when it's going to foreclosure, because you receive that written notice, both via certified mail as well as a public posting at the property. But with non-recourse loans, the borrower will not have to pay any canceled debt income because the lender is prohibited by law from pursuing any deficiency balance. So once they take the property back, that's it. They can't come after you for the remaining balance. So you're very well protected on those non-recourse loans. So hopefully that helps bring those two into place and understanding the importance between the taxable consideration for recourse, non-recourse.
Okay, great. Let's see. We're going to talk about hard money for a moment. Can you make a few comments on that, and then we'll move into our next poll?
Yeah. So a lot of people hear hard money, and what is that? And now you're having the emergence of private money, and hard money, private money. It's all basically the same thing. These are loans that are made not necessarily by non-financial institutions. However, they are loans that are made that don't necessarily follow traditional, conventional Fannie, Freddie, or the typical GSE underwriting guidelines. So, hard money is typically just a connotation that just refers to borrowers obtaining financing from a lender who can't qualify for conventional financing, and therefore that cost of capital is much more expensive than a bank loan. Therefore, it makes it a little bit harder to pay back, and hence the term hard money. But when you hear hard money, private money, non-conventional, they all kind of mean the exact same thing. It's just that the borrower is being underwritten from a non-conventional type of approach. And back in the 80s, you didn't really have a thing called Alt-A or subprime. I mean, that was really the emergence of that. So all you had was your A-paper borrowers, and then everything else was hard money. Well, Wall Street figured out a way to securitize that risk and to sell that risk to investors, and they actually made Alt-A and subprime more of a conventional product, and therefore it kind of got out from under with it being called hard money or private money. They called it instead Alt-A or subprime. Well, Alt-A and subprime are pretty much gone, and the private money is now filling in that void between your A-paper borrower, your conventional borrower, versus anybody else on that side of it.
I have a question coming in that I want to run by you, which is, can you use a self-directed IRA for hard money loans?
Absolutely, yeah. I mean, we have a lot of investors that are lending, making a mortgage to a buyer or to a borrower who's wanting to access capital outside of your traditional GSEs. So within your self-directed IRA, each company has different requirements, and maybe Karin might want to join in on this. Typically you can do first trust deeds within your self-directed IRA. You could do second trust deeds within your within your self-directed IRA. Some companies may allow you to do thirds and fourths, although it's not encouraged, and most self-directed companies will shy away from allowing you to do anything further than a second trust deed.
And just to jump in there, Brent, we do allow, an IRA can invest in anything but life insurance and collectibles. But you're right, when it comes to loans that have great amounts of risk, we do, sometimes ask for a hold harmless or something like this, because sometimes people get a little eager to do a deal which we think might not be good, but we're not advisors, so we can't tell you what you can and can't do so much. We just can say what is and what isn't administratively feasible. But yes, you can certainly make those kinds of loans from your IRA.
Thank you, Karin.
Perfect.
All right, good. Well, we've got it's time for another poll.
But to answer the question, and hopefully that did answer the question, that yes, you can use the self-directed IRAs to make private money loans, hard money loans, however you want to qualify that.
Very good. So speaking of hard money or private money, we've got a poll here. Let's find out, have you ever obtained this before yourself? Your options are never, currently in the process, within the last year, over a year ago, not sure. So the votes are starting to flow in now. We're skewing more toward never, although we do have a few who have in the past. Almost done here. Make sure you voted if you haven't already. So it looks like what we're seeing is that about 70% have never obtained private money, 20% yes within the past year, and 10% yes over a year ago.
Okay, great.
That poll.
Well, just because you're doing private money financing or hard money financing doesn't mean you're doing a recourse or a non-recourse loan, right? So still, you want to get in under the sheets and understand what that loan product looks like, and whether or not that loan is going to be recourse or non-recourse. So, going into private money, we do quite a bit of private money financing. We're very flexible in what we can and can't do. We lend on both residential as well as commercial properties. And we really try to get our hands around valuations very quickly. And as long as we can get our hands around valuation, we'll lend on that real estate asset. Some products that are very difficult to get your hands around on value are going to be raw land, as well as car washes, restaurants, any type of cash-based business where the real estate at hand, it's really more of a business loan as opposed to a real estate collateral. So we have a tendency to shy away from those loans that are business loans and really just focus on collateral-based lending, such as single-family residence, 1 to 4 unit properties, multifamily office, self-storage, so on and so forth. We lend on both owner-occupied as well as non-owner-occupied properties, as well as investment properties. Right. So an individual can be looking to purchase a secondary home. Well, the secondary home does not fall under owner-occupied, but they're also not going to be renting that property out. So it would be a secondary home, but we would treat that as a non-owner-occupied property. Or if you're obtaining financing within a corporation or within an LLC, obviously that would just be for investment purposes only. And yes, we do lend to both individuals. We lend to trusts. We lend to IRAs, self-directed IRAs, corporations, LLCs, LPs. Within the trust, sometimes what you have is you have some unnecessary exposure. A lot of conventional lenders will require for you individually to come out of that trust. They'll lend to you individually, and then they'll put the trust back into the transaction. And sometimes by coming out of the trust and coming out of that trust protection can expose you to a lot of unnecessary liability. And so within the private money side, we don't necessarily always require you to come out of the trust. So it just has to be structured the right way, and we have to make sure that we are lending on a non-recourse basis as opposed to a recourse basis. So we have a plethora of ways in order to underwrite the file. However, when you're looking at both owner-occupied or non-owner-occupied, we have certain regulatory restrictions in which we can and cannot do these days. So within owner-occupied properties, you can't do stated loans. You need to do a 100% ability to repay the loan. We need to make sure that loan in which we are making with that consumer is affordable, has less than a 55% DTI on both the front end and the back end. And we need to verify the income either through full doc, W-2s, pay stubs, tax returns for the last 2 years, or 24-month bank statements, or we can do an alt doc, especially for those self-employed borrowers. And there's another way in which we can do it, which is our asset depletion loan. So if you have assets that exceed the loan amount, we can underwrite it by depleting the asset over a course of time to then justify that the consumer has the ability to repay that debt. But again, I mean, just because you're doing hard money or private money financing, you can't 100% do a collateral-only based loan for those owner-occupied borrowers. You need to confine within the current rules and guidelines of the Dodd-Frank Act. So we've got to be very, very careful about that. Some other specific programs. I mean, we try to cover a plethora of different solutions for clients. We will do 30-year full AM with a 7-year balloon. We'll do a 30 due in 5. We'll do a 30 due in 10. Sometimes we'll do a 10-year or a 15-year full AM. We'll also do your traditional bridge financing, 2-year interest only, or a 6-month term, or 12-month term, or an 18-month term. It really just depends on what you're looking for on your end, and so we can structure that program accordingly and then price out that risk based off of your intentions. Now, if we're lending on owner-occupied, again, owner-occupied, where the federal agency is very pro-consumer protective, so there are certain things which we can and cannot do for owner-occupied financing. So if we're lending on an owner-occupied borrower, we cannot have a balloon less than 5 years. Actually, we take it one step further. We actually don't do a balloon less than 7 years for owner-occupied properties. We just want to be extra cautious, a little bit more conservative within how we interpret those guidelines. But there are most private money lenders will shy away from doing owner-occupied loans because they're scared of the compliance complexity. It's something which we have a firm grasp of. So we are doing quite a bit of owner-occupied loans. Our loan amounts range anywhere from $25,000 to $1.5 million. I mean, we can understand that asset. We can evaluate that collateral very quickly and make quick decisions in 4 hours or less. And then we also have the ability to go north of $10, $15 million per transaction. So our bread and butter really are those loans that fall in between $125,000 to $750,000. But we can get to the much larger amounts as well. Throughout the year, as we get flooded with capital, and if we have to deploy capital, we will do weekly specials, 3-day specials, monthly specials, just so we can get the capital out there and just attract the right product, right? I mean, it's all about supply and demand. If we have a lot of capital, we have a lot of demand out there from investors. We want to make sure that we're getting the right supply product to feed the beast. So, part of what we do is we will roll out weekly specials. So, right now, for those LTVs that are 55 and less, our rates are between 899 to 999 with anywhere from no points to 2 points on the lender origination side. And our rates will go down as low as 699 if we're at 25% loan to value. And so, but these rates change. Our weekly specials change. I mean, we do have our core rate sheets for both our residential and commercial properties. And then again, as we get flush with capital, we will put out these rate sheet specials in order to create some liquidity demands for that product. So,
thank you, Brent.
And I think that really.
I see
sure.
One of our participants has raised their hand. We're using the questions box there on your dashboard, on your GoToWebinar dashboard. So we encourage you to just type your question in, and we'll make sure that our speakers have an opportunity to answer the question. So go ahead and type that in, and we'll make sure that the question gets answered. This really is the opportunity for you to get any of those last questions that you've had answered. Both Brent and Karin have done a really good job, I think, in giving you some sense of how they approach the various challenges that come their way on a day-to-day. But if you have a specific question that relates to your situation, this would be a good chance to ask it. So we have one. Do you have access to investment property opportunities?
Yes. Quick answer is yes. And this is Brent speaking. If you go to the website ngres.com, and if you click on our active listings button at the top of the page, you will see all of our available inventory that we have listed on the local MLS, which properties we need offers on, which properties we need backup offers, which properties are already tied up and in escrow. And that is a continuously evolving list of inventory. I mean, every day we get new listings, and we're adding those to the website.
Great, and I would encourage that the person who's asked that question to give Brent a call. I'm sure you have some specific things that you're looking for so that you can get into a more involved conversation. We have another question here.
There are kind of going back to that. I mean, we also get tapes from Fannie directly that they're disposing of their REOs. So we are putting bids out on properties on a regular basis each week. We need to put in bids of at least 10 or more properties each and every time. A lot of times they're very unrealistic with their valuations, so we're not winning a lot of those bids, but we do get product out there on a consistency basis. So for those investors, especially in those more remote areas, the Tulares or the Fresnos or the Bakersfields or those special markets that unless you live there and you really understand the true value of those properties, there could be some great opportunities out there. And so if you are one of those investors and you're looking for using your self-directed IRA, I mean, definitely contact us, because then we can take some type of poll as to what you're looking for, and structure a very aggressive investment program for you for those properties. So when those tapes come out, we can be more aggressive on the bidding and try to get those products for you.
Okay, we have another question coming in here. What is the turnaround time to get my account set up?
Is that for the investment side of things, or is that within the self-directed IRA, or should we answer both of those?
I can answer the self-directed IRA portion, certainly.
Go ahead, Karin.
Setting the account up, it just takes a day. You give us the documentation that we need, and that's online, and then we get it open the same day. It's getting it funded that can take 2 weeks. So opening it the same day, getting money moved from a current custodian over into the self-directed IRA, 17 days is the average turnaround.
Very good. Brent, we have a question for you. Are you saying on your loans to investors that you check bank statements and do credit checks?
We do check bank statements and we always do credit checks, right? We need to know who we're dealing with and what the risk is with lending to that individual or corporation. If we are doing an investment loan, we have 3 types of lending programs. We can do full doc, we can do an alt doc, or we can do a stated only. So if it's stated only, it's what's written on the 1003 that we're looking at. If it's an alt doc or a full doc, we do need to underwrite the asset or the income, and to verify that those payments are indeed affordable. Now, our guidelines aren't going to be as aggressive as your traditional conventional guidelines. Within Fannie Freddie, we have different ways of looking at income, and we have different DTI requirements, but we are going to have to verify the income if we are doing a full doc or an alt doc. We can't just turn the other way on it.
Okay, very good. And another question here, what if you don't want to invest in California? Is that something that you help people with?
Well, we get listings in a multiple of states. I mean, we have listings in Arizona, Nevada, and Florida, Carolinas. I mean, so we can definitely help with that type of product. We also lend in other states as well. So, we're not we don't have bricks and mortar outside of California. However, we do lend in other states through our wholesale exemption status. So as long as loans are being originated from local loan officers that are licensed in that state, then we can then put an investor into that product out of state and be in full compliance.
Okay, very good.
Nevada has recently changed, and Nevada, in which we had a wholesale exemption, you need to have a brick and mortar now. So we are actually pulling our funds out of Nevada, and we will not be lending in Nevada come January 1st of 2013.
Okay, we are a little bit past 1 o'clock, and the questions are flowing in at a steady clip here. So we'll stay for another minute or so. But if you do have questions, I would encourage you to contact either Brent or Karin directly to get those answers, because pretty soon we're going to run out of time to address it in this forum. One question is, if we start the process of opening the self-directed IRA by the end of 2012, can we still contribute into the account until April 14 of the new year?
The answer is yes, you can. It just depends on the account type. If you want a solo K, it has to be opened and adopted by the end of the year. Really, there's not a lot of time to do that. We couldn't do it for you by year end because it takes a while to get all the documentation together and actually adopt the plan, so it's too late for that. But any other account type like a SEP, a traditional IRA, a Roth IRA, you can open it now and contribute up until the time you file income taxes in 2013. Talk to your tax advisor about the contribution amount.
Thank you, Karin. One of the attendees here is interested in properties in Georgia, Florida, Carolinas, interested to know if they can get properties on the tape. Brent, is that something that they could get through you?
Yeah, the best would be just to send me an email, and we should just take that offline and get better understanding. There are a lot of Georgia properties and Michigan properties and Illinois properties on the tape, right? So we can definitely get a better understanding of that, and we do get short sales within those states as well. So
good. Yeah, that participant said that they will contact you offline, so you can expect
okay.
that, Brent. And very good. I think we're out of time here, so we're going to wrap up. If we didn't get a chance to answer your question, again, we encourage you to contact our presenters directly, and we appreciate your time. Unfortunately, the deck is not available as a PDF, but we do represent this webinar from time to time, so do take a look in your inbox. You'll have another opportunity to review these materials live when we present this presentation again. Thank you, Brent and Karin, both of you, for being on the call with us. And we do encourage those of you who participated today to complete our follow-up survey. We'll be sending that out to you. That helps us by way of feedback so that we can make sure that every time we present this program, it's as effective for you as possible. Thank you all, and we will see you on the next one, hopefully.
Thanks, David.
Thank you, guys.